Hi there, welcome to the week ahead with Pivot Trader. Well, I think we have to have a look at bonds, don't we? After the huge move we saw last week with the RBA stepping back, we're waiting to hear from them tomorrow on Melbourne Cup Day, find out what's going on. Looks like they are backing off from their promise to keep rates near zero for the foreseeable future, which makes sense with inflation taking off, and worldwide bonds are also selling off. It's quite a sharp move last week in Italian, Spanish bonds, and to me, I think the German bonds are close to moving through the zero bound. I think they will return to positive nominal yields over there shortly. So it feels like there is a bit of pressure worldwide on bonds. So looking at the 3-year bond futures chart, which is what this is, the way the futures work is the yield on the 3-year bonds is taken away from the number 100. So you have 100 there, and when those 3-year bonds are trading at 97, that's saying it's 100 minus 3 is 97. So it's saying that the yield on those 3-year bonds is 3% at that time. So you can see recently those yields going to near zero, getting very close to that 100 level, getting up to 99.7 or whatever, and that's over the 3-year bond, 99.8, so 0.2 of 1% yield. So it's gotten up there, and what the hell it was doing up there in the first place, who knows? But this is the world we live in, and if we go up close, the RBA has been, printing money and keeping those yields there. But in the last month or so, the yields started to rise, even though the RBA hadn't said anything. People were really testing the RBA, and last week was when they stepped back from purchasing the April 2024 bond, and the yield increased massively. So that dropping means the yield is increasing. So going from near zero, where is it right now? Around 98.72, 98.72. So that's 1.3% in yield on those 3-year bonds. So I'd say what had happened is a lot of people would have been possibly backing the RBA and being long these bonds, and not really expecting them to back off in the way they did. So there's been a real exodus out of positions, and possibly we'll see this overshoot in the short term due to people probably having bad positions on, not expecting the RBA to have done what they've done. So you could expect there to be quite heightened volatility, and I don't know if it's over yet. We'll see tomorrow what the RBA says, but we are going to see quite a bit of volatility in this, I think, going forward, which was hitting stocks. We saw quite a sharp sell-off in stocks, interest rate sensitive stocks, last week at the end of the week. So it's something to have in the back of your mind. And the thing I've been a little concerned with, but not massively concerned at this point, but it is something that I have to note, is in that XJO, which is the ASX 200. We did actually get a monthly sell pivot a couple of months ago. It's now November. So that monthly sell pivot is when we got the monthly close below the low of the highest price candle there. And just the fact of where it is, that we have a monthly sell pivot in place after sort of breaching through these all-time highs, I'm always a bit concerned of false breaks. You saw before the COVID crash, we broke up through the old all-time high from 2007, and then it failed, and that was the beginning of that COVID crash. So the false breaks of highs can be a point where you've got to be wary. Like you can see there, we're trading for months. We broke out to new highs, and then that failed to carry on, and then it actually sold off for a year. And even through here, that high was maintained. False break there, sell off, broke through that high, false break, big sell off. So the false breaks I'm wary of, and what I wait for, is for signs that it's turning down. So you can see the old rally we had there. We got the monthly sell pivot was actually that really big candle there. So that was the January 08 sell-off. And after you get that monthly sell pivot confirmed, and that was a big one, but you do get volatility going back up into the guts of that candle. And that's often the opportunity to get out or to start getting short, because if it is turning down, that's where it will turn down from. So in this situation, I still need, more confirmation to really get bearish. I'm not really massively bared up. I'm just wary of the fact that we've got that monthly sell pivot in place. We're seeing some volatility up into the guts of that. If we turn back down, crack that 10-month exponential, crack below the high before COVID, there's just a chance of a bit of a sell-off taking shape. So still a bit early days, not time to run for the hills, but just something with these bonds starting to get volatile, and the setup really there, it is just ready to surprise to the downside a bit. So, but the US markets aren't really confirming it, so that's one reason why I'm not really freaking out. If you look at the US market, it's recovered and breaking out to highs again. But as always, as we break out to those new highs, this is the just a daily chart. So that was the old high from a few months ago. We had a bit of a sell-off, and we've broken up through the highs. But I guess be wary of the false break of that high. So if we get that sign, then we'll start to get a bit more bearish. But that hasn't happened yet. So at the moment, you allow this to play out, and it could do this going into Christmas with the Santa rally getting going. The bonds over there, the 10 years, seem to be flattening in the face of the heightened probability for tapering. So if we have the 10-year yield chart here, I've taken you through this before. That's that 1.8% level that I think if it does get above there, there's a heightened probability that we could be heading to 2.2% quite quickly. So I'm quite bearish on those US 10-year bonds on a yield above 1.8%. But at the moment it's holding in there, and it's trying to turn back down. It's down around 1.57% at the moment. And the more they confirm tapers coming, the more the bonds in the 10 years seem to rally. And so the short end yield's going up and the long end going down, even though inflation picking up and negative real yields, quite high, with 10-year bond yields at 1.6% and current inflation around 5.5%. You're losing a lot of money every year. So gold should be kicking higher, but it's not. Watching those US 10 years pretty interesting. If they do fall further, the rally could continue. Those tech stocks, etc., really taking off. But all bets are off if you see yields spiking up through 1.8%. Then I think equities will react. All right, that's enough for this week. Keep an eye on those bonds. We'll see what the RBA does tomorrow. And tread a little carefully, but it's still all right out there. All right, cheers. I'll come back with more next week.